Hi friends, welcome back to Murthy Finance Academy. Today also we will be discussing some more players from auto ancillary space. So the company which we are going to discuss today is none other than Pricol Limited. Yesterday I have made videos on auto ancillary companies like Lumax Industries, Lumax Technologies and SJS Enterprises. If you haven't watched them, please do watch and encourage them. So before we proceed, a quick disclaimer, I am not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Please do not consider it as a buy or sell recommendations. Now, coming back, so Pricol Limited has officially evolved from a legacy component maker into a diversified auto tech powerhouse. The Q3 fiscal 2026 results mark a watershed moment. For the first time in its 50-year history, quarterly revenue has breached the 1,000 crores mark. More impressively, the velocity of growth is staggering. For 9 months fiscal year 2026, its revenue reached 2,886 crore, has already eclipsed the company's entire full year 2025 revenue, which is around 2,621 crores. So Pricol is now the world's second largest instrument cluster manufacturer by volume, commanding a 65% market share in the two-wheeler segment and a 55 to 60% share of the overall Indian instrument cluster market. So this is what the company is into. The company has pivoted into a three vertical platform models. Number first segment is DICVS, which is nothing but driver information. So under this, the company offers TFT clusters, e-cockpits, heads-up displays, telematics, BMS. So this is a high margin vehicle intelligence and connectivity platform. The second one is ACFMS, which is actuation and fluid. Here the company provides electronic pure valves, disc brakes, oil or water pumps, cabin tilt systems. So this segment requires precision control and fluid management. And the third segment is P3L, precision products. Here the company offers dashboard assemblies, radiator grills, fuel tanks, exterior plastics kind of a thing. So here advanced polymer tech and physical real estate integration. So the revenue mix has also shifted significantly. While DICVS remains the core, the newly integrated P3L segment now contributes 23% of consolidated revenue. This internal scale up is perfectly timed, right? The massive technological shift occurring on the Indian dashboard. So the Indian auto ancillary sector is being redefined by premiumization. The dashboard is no longer just a housing for needles. It has become a digital cockpit. The shift has a structural tailwind for Pricol that renders unit volumes growth to content per vehicle expansion. The math is simple but explosive. As OEMs migrate from basic analog clusters to full TFT displays and e-cockpits, the bill of materials for Pricol components jumps from roughly 500 per vehicle to a range of nearly 5,000 to 10,000. So this 10x to 20x expansion value per vehicle is the primary engine of the current revenue surge. So regulatory environment are also providing forced demand. The anticipated mandate for anti-lock braking system across all two-wheelers is expected to trigger a massive adoption of disc brakes, a segment where Pricol is currently ramping up mass production capacity. While the company competes with heavyweights like Minda and Bosch, its hyper focus on driver information and a robust R&D speed of nearly 4.5% of revenue allows it to maintain a dominant technical moat in specialized electronics. So the company's valuation is also undergoing a fundamental re-rating. The company is not just riding the tide, it is consistently outperforming the underlying auto industry by 5 to 7% pointage every quarter. Its DICVS and ACFMS, the legacy segments are firing on all cylinders. Export performance grew 15% in this quarter, anchored by major global accounts like Caterpillar and European OEMs. Its latest segment, T3L polymer segment, is a currently high class problem. Operating at 90% plus capacity utilization, the segment is stretched, necessitating a planned 500 crores capex, while the P3L's 9.33% EBITDA margin temporarily dilutes the consolidated figure. The strategic so what is vital. P3L provides the physical real estate, the dashboard housing into which Pricol can embed its higher margin electronics. This vertical integration allows Pricol to capture more of the vehicle's total value. So, in an environment of volatile commodity prices, Pricol's 100% back-to-back cost pass-through with a 3 to 6 months lag ensures that raw material spikes do not structurally impair in the long-term profile. So, the in Q3 fiscal year 2026, the company reported nearly 66% of revenue jump, which is a combination of 15 to 18% organic growth and in the inorganic boost from the P3L consolidation. The consolidated EBITDA margin of 12.19% remains stable despite the drag from P3A, which is around 9.33%. As P3L efficiencies improve toward the 10.5% target, we can expect margin exertion. So the finance costs are an eyesore, quadrupling to 8.6 crore. However, this is not a debt trap. The company has zero long-term borrowings. This interest burden is driven entirely by working capital needs as trade receivables surged from 287 crores to 590 crores to fuel the revenue explosion. So Precol is in a growth-heavy phase. Earnings quality is high, but the business has become significantly more working capital intensive. The zero debt balance sheet is the only reason this quadrupling of finance costs isn't a red alert, providing a safe runway for the upcoming 500 crores capex. And operational efficiency metrics validates the passion to excel motto, but they also highlight the pressure points of rapid scaling. Its ROC is nearly at 22.9%, consistently outperforming the industry median, and ROE of 117.6%, and the P3L utilization at 90% plus are some of the key KPIs to be tracked. And debtor days also jumped from 46 to 64 days. This is the smoking gun behind the increased finance costs and represents the primary area where the management needs to tighten the screws. And commodity lag of 3 to 6 months pass-through lag continues to create temporary volatility in quarterly cash flows, though the long-term margin protection remains intact. So the company's execution is its strongest moat. The Q3 management commentary provided clear evidence of technical and strategic agility. So it's next period crisis resolution. So management successfully de-risked China-sourced passive parts within a single quarter, gaining OEM approval for alternates. Solving a supply chain crisis in under 90 days earns high marks for credibility. Next is BOE partnership. So the exclusive MOU with BOE, which is the world's largest display maker, is transformative. By localizing LCD and TFT production, Recall will capture the display BOM, the most expensive part of a digital cockpit, which is currently lost to imports. Investment starts in 3 to 4 quarters, with production expected in 4 to 5 quarters. And guidance also, management expects the momentum of 8 to 12 quarters of outperformance to continue, backed by 25 plus EV startup wins and a robust new product pipeline. So the company's scorecard, management scorecard execution is elite because it de-risked China supply in less than 90 days. And its strategic vision is very high because of BOE partnership, which captures the high value display market. And its reliability is also solid, meeting P3L integration targets and maintaining 15% plus organic growth is not a small thing. And the call is currently in the midst of a re-rating. The market is moving away from valuing it as a traditional component maker because historically it used to trade between 20 to 25 times of PE and towards a tech platform multiple. So currently the company is trading around 32 to 36, whereas the peer like Udominda, Bosch and Samvardhana Motherson are all trading well above the 32 range of PE. While the current multiple is a premium to Pricol's history, it remains at the lower end of the peer set. The premium is justified by the content per vehicle expansion story and the BOE localization play. So the stock is priced for perfection, but not necessarily expensive compared to peers. The upside depends on P3L margin expansion and the Q1 fiscal year 2027 ramp up of disc brakes. It is a classic price to growth trade-off. So coming to some key red flags which I have observed are low promoter holding at 38.51%. The promoter stake is thin for a mid cap. This creates vulnerability to sentiment shifts in institutional hot money rotates out and working capital stress. The doubling of receivables and the resulting quadrupling of interest costs are the biggest risks to free cash flow. Third is customer concentration. Heavy two-wheeler reliance, nearly 65% of the share of revenue, leaves the company exposed to any downturn in rural consumption. And the fourth is execution risk. The BOE localization and mass production of BMS must hit tight timelines to justify the current 35 times multiple. So coming to its key strengths, 65% in two-wheeler market share, zero long-term debt, 100% commodity cost pass-through are some of its strengths. Coming to weaknesses, low promoter holding, high interest burden due to working capital, and diluted T3L margins. Coming to opportunities, BOE display localization, 25 plus EV startup wins, and ABS mandate driving disc brake demand are some of the opportunities. Coming to threats, two-wheeler industry slowdown, China supply chain dependencies, competitor leapfrogs in e-cockpit tech are some of the threats to be watched out for. So, what are the some key monitorables to be tracked as an investor, or if you're going to invest in this company in the future? Are its P3L EBITDA margins. Target is 10.5%. Any stagnation here will drag down consolidation results. Second is disc brake mass production. Track the start of production with the large two-wheeler OEM in Q1 fiscal year 2027. BOE investment. Monitor the commencement of capex for LCD of TFT localization in the next 3 to 4 quarters. Debtor days. Watch for reversal from 64 days back toward the 45 to 50 day range. And the fifth is promoter stake. Any opportunistic buying by promoters would be a major positive signal. And sixth is BMS validation, successful testing with premium two-wheeler customers. So Pricol is at a interesting point and not available at a not so costly or not so premium kind of a thing, but average kind of a valuation. So keep a track on this company. Whenever it reaches to your comfort zone, you can add this to your bucket list or watch list. Okay. So hope you like this video. If you do like this video, please do like, share, comment, and subscribe to Murthy Finance Academy. Thank you.